Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all.
So honored.
So honored. Patrick, it's been quite a while since we did this, right? I feel like in true Seinfeld spirit, we must have violated some statute of limitations somewhere. Well, we call it a weekly podcast and feels like we've stretched the weekly definition quite a bit here. And that has also taken us into a new year, by the way. So happy new year, Patrick.
Happy New Year to you too, Shub. I
Yes.
hope you came into the new year well rested and ambitious.
Yes. And true to form, I'm also wishing you a happy new year slightly later than what Seinfeld loyalists would typically want. So that's also like a violation of the statute of limitations. But let's get cracking. It's a new year, exciting things, coming up in the horizon. And I guess that's as good a segue for you, Patrick, in this brand new restart for us.
Sorry, are you referring to the use of the word kraken? Is that what?
No, I'm referring to tracking with new start, new beginnings, exciting things on the horizon.
Excellent. So
Yes.
we were blessed with, I was on the other week. I was on with the guys from Bricks, Bucks and Bytes. Owen, Dustin, Martin.
Mhm.
And they asked me for a juicy hot take, okay? And I really am not someone to go for juicy hot takes, but they lured it out of me, and I said, this year we will see three $1 billion exits in the project economy, construction tech, infrastructure, etc. So today we might already be discussing one of them, which is why from my little cupboard here, from my shelf, I got this little thing.
Oh, look at that.
Yeah,
Very cool.
bucket loader. Yellow machine, because you and I want to discuss that we were blessed, we being the public, blessed with the S-1 brochure from Equipment Share. So Equipment Share is filing to go public. It has published its S1. Beautiful, because it allows us to analyze the business. We have a bit of privilege of having similar marketplace type businesses, also at a very similar, perhaps maturity is the correct term, in our portfolio. So bit of a privilege for us to have public but private, experience. So that's quite cool, I think, and it's very rich. I think it shows, just as a summary, I think it shows a business at a very substantial scale, really interesting also how they found certain capitalization solutions. At least that's something I want to talk to you about as part of this conversation, and how they also build more and more surface area of product. I think that's another thing. In the numbers, you also, like there is no perfect company. We will also look, obviously going through the numbers, we will also see 2 or 3 areas where we're like, okay, perhaps management needs attention here. So yeah, I would say we start right in. And why don't you, if you can, Shub, summarize in a nutshell, just, hey, what is Equipment Share doing? What's the business?
Before we go there, I also want to share why I think I feel like it's a nice moment of celebration for us, whoever are, believers in the construction tech ecosystem. Perhaps you might remember this, Patrick. An early exercise we did when we started Fundamental was mapping out, which companies have so far, which construction tech firms have so far raised the most capital, right?
Yeah.
And see if there's any pattern, there's any semblance of something for us to glean from that. And I think one of the companies we identified as a Sunicorn, I don't think it was a unicorn just yet, perhaps more or less in the similar ballpark, but in the Sunicorn ballpark was Equipment Share.
Yep.
And I think a testament to how good of a company Equipment Share is, I think none of the other companies in that list have yet gone public from that list, because, oh no, my apologies, Procore did. So it's only the second. It's only the second company from that list which has gone public. So that shows you how big of a deal Equipment Share is, where it was a high quality company in 2018 and it has preserved its stature and gone on to greater heights from there. So it's a moment of celebration for the ecosystem.
I agree. I agree. So let's do that. We're
Yes.
blessed with the information, blessed with the IPO.
Yes.
Shub, let's not, I think everybody can read up on it, but just give us context in a nutshell. What's the firm doing?
Yeah. So it's a firm based in the US. It's started off as a marketplace for renting yellow machines. So think all those big yellow machines, excavators, cranes, whatnot that you see operating at construction sites around the world. They originally started as a rental market, as a marketplace that allowed you to rent these machines for use. There you go. So it allowed you to rent these machines. Over time, I think after the first 3 or 4 years, I want to say, or perhaps a little bit longer, they started adding other aspects to the business, offering spare parts, services to go with it, offer telematics as well, which is kind of like the fleet management program to go with all the machines that they provide. More recently, I think they've introduced newer programs like a program which allows third-party debt to sort of buy into the fleets that are on their platform. As in, Equipment Share doesn't own the fleet. You, as a debt provider, get to own the fleet, and then you lease it back to Equipment Share for a yield. And finally, very interesting, Patrick. They've also launched a building material, a one-stop shop for building materials, which of course is a theme you and I are quite familiar with.
Yeah. Which, by the way, they don't feature on the highlight of a brochure. So for those that are currently on audio, we have the brochure on, and they feature basically 4 parts to the business. So there's rental, there's equipment rental, there's equipment sales, parts and service. So basically the whole let's keep my machine park running part of the business. And then the T3 platform with cloud connected access control, which I will also have comments on. They don't even mention materials here. However, they do mention in the market opportunity, Shub. You remember where that slide was? How they are thinking about the one-stop shop. And I think before we go into more numbers, that's very important, because what we love about InfraMarket, for example, is that the one-stop shop compounding elements of InfraMarket. Oh, here we go.
That was the one, Patrick. Yeah, this
Exactly.
is
Here we go. Yeah. So, and I think it's very similar how Equipment Share is thinking about its own business. Oops, I think I just screwed it up. Here we go. Yeah. So basically, what they are showing is, okay, here are all the different spend buckets of the construction industry. They are showing like a wheel, whatever, right? And they're showing how in colored in orange where they are today, and how it basically was launched, how the TAM is. So exactly what you said: equipment rental, telematics, etc. And then at some point they wanted to launch materials and construction insurance. I think fuel, that was surprising that it came that late. That I would have thought perhaps would have been easier to unlock earlier, but that was as an outsider, an intuition, might not be correct. So really nice one-stop offering for the customers. We always say, Shub, you and I, the hardest currency in the project economy is track record. And so when you actually have that and you continue to deliver outcomes and you earn that track record of delivering the outcomes, you can always add more. Your customer will always be inclined to take more from you, who keeps delivering, who has the reputation of reliability, you perhaps have good prices, then rather go to another new vendor. So that's why oftentimes in the project economy you can compound so much, and Equipment Share is doing the same thing.
Yep, absolutely.
Let's analyze revenue first, Shub. So let's start maybe with a juicy, the pitch deck overview that they have provided, but then we have a bit of additional numbers on this one. So here, right? What are we seeing?
Look, the first thing that jumps to me, obviously, it's a nice curve going up and to the right, as they say. But more than just up and to the right, I think the sheer weight or the absolute value of the numbers is extremely impressive. So this is a company which is clearly operating at a very large scale. In terms of revenue, I would say this is most definitely product market fit. So it doesn't need you to, I guess, buy into a story, etc. So for those of you who have joined over audio, in the calendar year 2024, they did 3.8 billion in revenue, which I'm sure we can all agree it's a very sizable number for a private venture-backed company.
10-year-old.
A 10-year-old company, and it's been a steady rise up into the right in revenue terms.
And what we're also seeing is what I found interesting is that actually the third year seemed to have been very difficult for them. So 2017, you saw at that scale only a 50% year-over-year growth.
Yes.
Not that good at that point in time. Huh? I mean, it's a GMV business that early. And so they ended 2016 with 20 million fiscal year GMV, and then 2017 with 30 million GMV. For a marketplace, 30 million GMV in year 3 is completely respectable, but it's also not that hard to achieve. So we've seen it in many, many marketplaces, actually. So then to have only 50% growth, I'm sure that was a tough year, and also perhaps fundraising, maybe, I don't know, they probably got feedback on it, etc. But then they really figured something out. They added equipment sales in 2017. And in 2018, they opened their 20th location. And they added the service business. So to me, these three were probably the reason why they then begin picking up pace again. So equipment sales, services business, and the 20th location. And so today now, they're at 290 locations. So these locations is basically, okay, here is where you can get your equipment. We'll deliver them to your site. You can buy them, you can rent them. And they're all equipped, to my knowledge, with a T3 telematics system, through which you can then, orchestrate. I think more importantly, for equipment share, they can actually probably block or brick the machine. That is what I am thinking. Do you know that, Shub?
I don't know it for a fact. I think it's definitely a compelling play, and I would say a credible play if that is indeed happening. I would see it as highly plausible.
Yeah. So imagine customer doesn't pay the rent, or that customer doesn't pay a lease payment in case that's part of the offering. Well, now you can brick the machine and make sure they don't have use of it. Now you can actually then, so first of all, incentivize payment, and B, anyway, you're going to have to now take repossession, but let's make sure nobody can use it in the meantime. So I think that's a real asset in the T3. Why don't we break the revenue down a little bit? I'll stop screen share, Shub. So where does the big revenue come from?
So from what I could gather, Patrick, so there's two, big chunks of the business which account for, I would say, the lion's share of the revenue.
Yeah.
And that is the rental, the equipment rentals, and the second being equipment sales, as they call it.
So for the 9 months of 2020, of the fiscal year 2025, so they filed with the Q3 2025 numbers. In those 9 months, they reported 2.8 billion in revenue, 1.7 coming from equipment rental, and another 800 coming from equipment sales.
Yeah. So that leaves just, I think the what remains unaccounted for is about 300 million.
Correct.
So even I couldn't find a breakup of how that's...
No, I do have it in front of me. So the other 300, break up 200 is the aftermarket, after sales part, so parts and services. And then they have what they call platform revenue. So this is interesting, right? So the telematics product, I think, is strategically very important to equipment share, but you can't see its importance in the revenue breakdown. So in the revenue, it made 35 million of those 2.8 billion. And then they show other revenue, 41. We'll come back to that. Remember the wheel, the one-stop shop. So everything else in that wheel is this 41 million, right? So for example, the materials business they claim to have launched, etc. So clearly it's an equipment rental and equipment sale company that has certain platform benefits, being a one-stop shop and having telematics.
Yeah.
That's how I would characterize it.
And I agree with you. I think it is highly likely that the telematics part of the business, even if it's not adding revenue, it's probably very strategic to the sale and leaseback program as well. The security program they have.
Now, speaking about revenue, let's speak revenue growth. So in terms of fiscal year revenue, not run rate. So we mentioned the 2024 was 3.8 billion in gross revenue. 2022 was, I believe, 1.7. So overall, I think at that scale, that's like a 45% CAGR between those 2 years. What is it, 43, 45, something like that?
Broadly, yeah.
at that scale, that is a very good growth rate.
Absolutely. And I think the key, so obviously between those 2 years at that scale, phenomenal performance. I think the key thing to look out for is if they can maintain that growth rate or have something in that sort of ballpark coming through for fiscal 2025 and maybe a year or two after that as well.
Interesting, no? So I think we'll have more points on the Q4 revenue later. Let's park that, Shub. Let's talk profitability. What did you find?
So the interesting thing is, I think depending on who you are, you can choose to look at either the adjusted numbers, where they make certain changes, additions, subtractions, etc., or the GAAP numbers. I think the GAAP numbers are interesting in the sense the gross margin broadly is in tandem with the revenue growth rate, right? And yet, in the last 2 years, you see a clear drop off in EBITDA, net income, etc. So it suggests that the core business line profitability in terms of the revenue and COGS items, that hasn't fundamentally changed. But there's something else about how they earn that revenue, which is causing them to see a lot of OPEX, right? And specifically, what seems to have changed is there's a lot of depreciation expense, there's a lot of finance expense, interest expense, which is really weighing down on the P&L.
Wait, did that change actually over the last, let's say, 3 years?
Yeah, it has.
In what way?
The depreciation and interest expense is okay. Look, I was about to say ballooning. I think that's not the appropriate thing to say. It's still a well-run company, but it has dramatically expanded. So imagine revenue and gross margin or gross profit growing largely in the 40-odd% year on year.
Yeah.
Debt suddenly expanding in a way where the interest expense and depreciation are growing in multiples of that. So what the effect you have is, even though your gross profit is higher, your operating expenses are so much larger that actually your profit pool is shrinking. In fact, I think it shrunk to the point where it went into the negative in between as well. Yeah, in fact, the 9 months getting into 2025 was negative 25 million. So they had a net loss of 25 million for the 9 months of 2025. So sorry, just to read through the recent trends, right? 2022, they had a positive net income, so profitable, of about $50 million. 2023, they had a profitable net income of $17 million. So already there's a declining trend. 2024, the net income was $2.4 million. So again, continuing to decline. It's almost like at a break-even stage at this point. And in 2025, it now goes into a loss situation. All this is happening while the gross profit is expanding. So clearly the problem lies in the operating expenses item.
That's a very important giveaway. Shub, did you see, I don't want to jump there, but did you see when the OWN program was introduced? When did they use it? When did they start using it?
So I remember reading somewhere sometime between 22 and 23. But I might be wrong. I'm not very confident. I remember reading that somewhere.
Yeah, then that would fit, no? Okay, understand. So what I also found on the profitability, so I think we are currently 70 million minus last 12 months, as per end of September 2025. Not absolutely terrible. In fact, I would say far away from being absolutely terrible. If you consider the growth rate of the business, I would consider that a quality company. I think that assessment changes very quickly once you start slowing growth.
Yes.
To which I have a point later. But 70 million for a company that can legit claim it continues to grow 45, let's say even 35% year over year for the foreseeable future, and you keep adding to your platform, you're gonna compound more on your one-stop shop. Completely okay. The company can clearly raise capital. It has a debt of 3.7 billion currently, which is, I mean, that's a large number. So they clearly know how to raise capital, and they clearly know also historically how to grow. I think that's completely fine, but it needs to be added to the context. On the profitability front. Then, Shub, what we should also discuss is, let me just briefly go back to the brochure. What we should also discuss perhaps is What about the leverage and the liquidity situation?
Yeah. So I think so. When I made that observation that while the gross profit was expanding, the net income was declining, and made the observation about EBITDA and finance costs, interest expense going the way they were, I suspected that perhaps that's something to dig further into. And from at least what I could see, depending on what definition of EBITDA you use, either the GAAP number or the adjusted number. So even the adjusted number yields a debt to EBITDA ratio of 4, which is already quite high, right? And mind you, the adjusted number makes a ton of adjustments, adding back a lot of things which I guess more orthodox finance professionals would probably not accept as appropriate adjustment. But if you, let's say you work with the GAAP numbers. So the GAAP numbers show a debt to EBITDA ratio of 10, which is quite high, Patrick, quite right. For those of you interested, why is that relevant? Because ultimately you service your debt from your EBITDA. You don't service it from revenue or any other line item above EBITDA. So that's why it's relevant. Effectively, what it means is even if you were to be able to use all of your EBITDA to pay down the debt, which is again unrealistic because there's taxes and whatnot theoretically that you would have to pay, it'll still need 10 years, which usually means it's quite a big burden you're carrying, and it's not easy to remove that debt burden, basically. So that's perhaps something the company uh, could look at. That doesn't always need to be that it needs to reduce the debt burden. It just needs to maybe get a quicker yield, or get the debt to demonstrate its returns fairly soon. And I imagine public market investors are fairly demanding in terms of when they expect to see results if you decide to add leverage to this extent.
Yeah. I'm actually right now looking at the statement of operations for the 9 months 2025, right? And so the own program payouts, own is the way how they finance a lot of the equipment, and I think it's quite genius. We'll talk about it later. As part of the gross profit, I think that's correctly accounted. So that's, my opinion, the way to do it. And then they have other interest expense of another 210 million in those 9 months, which come further down the line. SG&A is 680. I thought that was quite high, to be honest, for a marketplace type business.
So it is. So the reason why I could not figure out to what extent to make a judgment based on that, because it is possible in a business like this, in a build up to an IPO process, perhaps there's other things that are getting added in there. So I think I at least I was not able to either find or have enough of an informed opinion on whether that's like good SGA or required SGA, or perhaps SGA with a lower yield in terms of a spend.
I
But
don't think it has to do with the IPO, because the SGA intensity actually stayed the same compared to pretty much the same compared to 2024. So they're at about 23 to 24% in both years.
Of the revenue?
Yeah.
Oh, that does.
That's quite high, huh?
That is quite high. Yeah.
So they have locations, 290 locations that you have to have. That's fixed cost. That's overhead that you need to run with. So that for sure plays a role here. Especially, I guess, if it's expensive real estate. That should not be the case, I guess. Don't know. But that's overall a pretty surprising number to me, the SG&A intensity. And then, so the net loss that they report in the statement of operations for the 9 months 2025 is 25 million. And for 2024, 50 million. And I saw somewhere else for last 12 months, it was 70 actually.
Yeah, correct. I also remember something in the 70s.
Yeah.
Yeah.
You did mention the gearing, the leverage ratio. So equity to debt between 4x to 10x, whether I use GAAP or non-GAAP. Did I recall that correctly?
Oh, it was debt to EBITDA. So the
Debt to EBITDA.
Yeah.
Okay. Debt to equity was what?
I think is about 7x, depending on, I think 6 to 7x. I'm seeing like so equity is only about 12 to 13% of the assets. The rest is debt.
And I saw an S&P forecast as a review of the S-1. S&P thinks the company can only deleverage to the mid 4x. Just to get it right, on the cash from operations to debt. So cash from operations is not exactly the same, guys. Folks, don't at me, but many people will, if they can't get the EBITDA, they'll take the cash from operations and vice versa. So it's sort of the same thing as Shub is saying. So mid 4x area, that is not something, if that's the best that S&P thinks you can actually do with your business, yeah, that's a very, very debt intensive business.
Since you mentioned cash flow from operations, I also recall reading and making a mental note that the cash flow from operations was becoming more and more negative over the last 2 to 3 years. And more of the cash flow was actually supported by financing cash flow rather than operating cash flow.
Mm-hmm.
Actually, okay, I need to correct myself. That is not true. So, cash flow from operations has always been positive in each of the previous full 3 years. But the capex has been going at such an extent that free cash flow has always been negative, and the extent to which free cash flow is negative has only been increasing over time.
Yeah, to be fair, however, so this is where I think we need to explain the own model. To be fair, Shub, I think that's a result of growth, and I'll explain you why. So the way they have structured the own model is very innovative, in my opinion, and shows real financial savvy, and then I'll explain why it directly correlates to your observation. So the way they have done the own model is they've actually at some point reached so much scale and underwriting ability that they were able to securitize into ABS, asset-backed securitization, pools and tranches, the equipment as well as the lease commitments from purchase customers into these. And so that's the own program. And then what they did is as an ABS, typically you give it to public investors. That's the let's say gold standard of an ABS. Think of it like a CDO for mortgages, sort of. And you give it into the market, and then public investors purchase it because it's collateralized, right? So you have the value of the equipment in there, plus you have the collateral of the lease payments in there. Quite high quality in Equipment Share's case, if you believe that Equipment Share is very good at A, underwriting the customer and the machinery, and B, very good at taking repossession. It's a mobile asset. And it is an asset with high residual value because it has a strong and fungible second-hand market. It's a very brilliant move, in my opinion.
Yeah.
And they seem to have mastered that. That has contributed a lot also to the obligations that they have in the balance sheet towards the ABSs, etc. However, the way the model works is they purchase the equipment first to the balance sheet before they ABS it. And that's normal. You first need to build a new portfolio until you can bundle it. You need to first then get... So in this kind of a business, you can't find customers who tell you, okay, buy me 500 of these machines. It works the other way around. You buy the machines, then you find the customers, then you need to have enough of them to bundle them together, and then you can securitize it. So you will always actually have the cash flow, the capex, always in your business first, and it will show up in the balance sheet. So now if you grow the way that they have grown, back to your point, with 45% over the between 2022 to 2024 in terms of fiscal year revenue, you're expanding your machine park. And so that also means that you're taking on more of that capex initially before you can push it off of the balance sheet again. So that's why you have the cash flow effect. This will not happen the moment they start growing. So the moment they start growing, the cash flow will actually become better just as an effect of that. Does that make sense?
It does. It does. Yeah.
Very innovative own program. I did not expect to see that in the business. That's pretty cool, actually.
It is.
So in total, I think the own program has capitalized the business. I saw it somewhere with, I think, 2.8 billion.
Yeah. I think I remember seeing 2.9 billion somewhere.
Yeah. So you need a very, very good finance team to do that. You and I know a little bit about that by now. That needs to be a very strong finance organization that you would otherwise only find in aircraft leasing companies and the likes.
Absolutely right.
So Shub, what do they want to list for? What are they seeking as part of the IPO?
So I think I saw a range of around 6 to 6.4 billion. So for the sake of simplicity, let's go with 6 billion. That's what they're seeking for. Interesting, side observation. It is lower than some of the recent private rounds. Or the valuation they have raised in their private rounds.
Oh yeah, there was a secondary round, no?
That's right. If I recall the number, that happened around a 9.4 or 9.5 billion valuation.
Right.
So it is a mark down from that valuation for sure. I don't know if there was like an implied question in what you asked on what our take is on this valuation.
Ooh, I mean, if you want to give it, I at least haven't done enough. I haven't spent enough time with the S1 to really have like a super hard valuation. However, I will just, before you go, I will just point out, so that's like, what, an 1.8x on gross revenue?
Actually, even less than that. So I think trailing 12 months is about 4.4 million. We're not even talking about a billion. My apologies. We're not even talking about annualized rate. Actually, the annualized might be a little bit lower, but if you take the trailing 12 months, that's about 4.4 billion. So that's just 1.35x, give or take, of trailing 12 months revenue.
For a very high gross margin business compared to perhaps peers.
That's right.
So does that mean you're buying?
So look, high level, okay, obvious disclaimer, this is not financial advice, etc., etc. I think I also, like you, haven't done enough analysis on the S1. I have to make, so look, and it's hard to, I think the reason I'm going with the multiple of the revenue is because obviously the net income, etc., is negative. EBITDA, it again changes wildly depending on whether you use the GAAP numbers or the adjusted numbers and so on. On a revenue basis, I think it would be hard to argue that as a multiple of revenue, it doesn't seem like a low multiple. And it seems like conservative assumptions have baked in to come to this valuation.
Okay.
So in my mind, perhaps not too much needs to happen to justify this valuation. I'll put it that. Yeah.
So here's one reason why I will not buy. Avid listener, you definitely know this, and our two avid listeners that always tune in. I'm joking. Will also know I've stated on multiple times I do not buy stocks in companies that are not where the CEO is not someone that is either the founder or purchased a large chunk of shares themselves. That is satisfied here. However, they are asking for 20-1 voting shares for the founders. That is a rule I'm also not breaking. I do not like that. I do like founder influence, but I think that undermines governance. I personally, it's not my taste. It's not what I want. I think it's going to be a kick-ass IPO. I think they're seeking roughly 700 million. I don't think that will be a problem filling it. It's a very high quality, high growth, compounding one-stop shop. Now, before we end the call on just this whatever, fanboy, we're definitely fanboys of the company, I think. There are, I think, 2-3 observations that warrant further looking. Okay, so let's also not forget those.
Of course.
I found it very interesting, Shub, that mature locations, so the ones that have been established years ago, are much more profitable than new locations.
Okay.
So you see that mature sites actually have an adjusted EBITDA margin above 50%. So it says adjusted. Figure out yourself what that means. And if that is true, it must be gross margin. It can't be EBITDA margin. That is impossible. So, but it has on average 10% higher margin than locations that have been launched recently. It shows that there's a build-up phase to new locations. It might also show that the new locations are less attractive and less interesting, and that you're getting into smaller and smaller markets and smaller pies. Something, if you had access to the founders, you would discuss with them.
Yeah.
So that, I think, is important, right? So it could be 2 reasons. The second one, so we discussed the T3, right? And so we had in the revenue breakdown, okay, it actually only accounted for like...
less than 1%?
Yeah, exactly. A little bit more actually. So I think it was 35 over 2,800, so like 1.3%.
Oh, but it's not. It's 3,800. But anyway, I think now we are.
No. The 35 was on the 9 months for 2025.
I see. Okay.
Yeah. So it was on the 2.8.
Fair enough. Yeah.
Doesn't make a big difference. So let's not bicker over it. But like 1.3%. So I think as a story, it's important to have it in there. I think for the finance product, the incentivization of customers not to miss payments, etc., it's very strategic. To have it, I would die. I would absolutely die wanting to know how much they spent on that technology. Because if you now make the ROI calculation, it would be really, really interesting to know. Because this business, Shub, do you think this business would exist without T3?
No, because I think without T3, the own program would not be as viable or at least operating at the scale that it is.
That's
So
why it's strategic. I
yeah,
agree.
yeah. So I think the company would still be a great company, but the sheer scale would be quite a bit lower.
Okay, I agree with that. So now, if you spend 10 million on it, fantastic. If you spend 50 million on T3, okay, yeah, you know. If you spend 200 million on T3, okay. So just second observation could be a bit fun to play with that. And then the third and final observation from my end, Shub. So if you really want to go down a rabbit hole, look what happens in Q4 to revenue in this business. So Shub, you know what I'm referring to. Why don't you tell us?
Yeah. So look, obviously we have, so the company has reported this S-1 after 9 months 2025. So what that allows us to uniquely do, so as a comparison, what they have is full year 23, full year 24, 9 months 2025, and because they need a year-on-year comparison, we also have 9 months 2024. So based on that, you can precisely estimate, or actually not estimate, precisely calculate what Q4 2024 was. And it was an unusually large quarter, perhaps the very best quarter in the history of this firm. And thereafter, I mean, we don't have a quarterly breakdown, but it seems like thereafter, again, the revenue seems to have slowed down a little bit, maybe at a lower level, etc.
Yeah, I mean, Q1 25 was nowhere near
Correct.
Q4 24.
So somehow there was this abnormally large quarter in Q4 2024, and then it again sort of drifted into a lower scale again for some reason.
So could there be reason? So unfortunately, we don't have the 9 months 2023 because they're not obligated to report it. So we don't know. Was it an outlier or is every Q4 in this business that case? So I can think of organic reasons why in this business Q4 would be terrific. That would be on the equipment sales side. Budget cycles, I still have budget left over, etc. Maybe yearly downtimes on construction sites are being used for servicing and maintenance, also entirely possible. The problem I have with these two explanations is, well, you know what? The biggest revenue driver is equipment rental.
Yeah.
It's not equipment sales and it's not aftermarket.
Yeah.
So that's something where I struggle with that explanation. The implication of that is this. If Q4 2025 is not okay, let me just say it and then okay. If Q4 2025 is not programmatically a killer, like every Q4 is a killer, did you actually mention the scale of how much bigger Q4 24 was bigger than the other quarters?
Yeah. So to give a sense, Q4 2024 was about $1.5 billion. And just for context,
On a 3.8 billion year.
Correct. And for context, the 9 months 2025 is about 2.8 billion.
Correct.
Right? So Q4 of 2024 is more than half of 9 months 2025, just as a comparison.
And 40% of the entire revenue of 2024 was Q4. So the implication is if Q4 25 is not also programmatically such a killer, 40% of the revenue of entire 2025, then effective, and let's say Q4 is on the same growth trajectory as the other 3 quarters, then actually 2025 will be the same revenue as 2024. And then your growth rate is not 45% year over year. Then your growth rate is 0%. And then your cash flow is problematic. Then your debt is problematic. So if you listen to this entire episode, that is the implication. So now consider the timing of writing this S1.
Indeed. Yeah. I mean, look, one of the, actually, you know what, let me not say it. I think I was about to say one of the implications of having negative income, negative free cash flow year after year, and the negative free cash flow also increases is eventually it needs to be financed one way or the other.
Yeah.
Either through debt or equity. Now, the company could choose to take on more debt, but we have already spoken a great deal about where the company is with regards to its leverage. So what that does mean is more equity, which also means you can expect even post IPO, perhaps even more additional dilution. How much more? I think that's obviously a function of several things, but that's something to also keep in mind.
So truly how this business becomes, in my mind, from the 6 billion valuation they're seeking, a 60 billion company is you need to completely diversify away from equipment. You need to be right about your one-stop shop thesis. We saw the materials business and all the other revenue streams made up 1% of the revenue in the first 9 months of 2025. They claim they launched the materials business in 2022. I had never heard any customer mention it. But if you now want to compound further, it can't be on the equipment side because your balance sheet will just not be able to, and your cash flow statement, to support a very high quality capitalization of your business. So you probably have to now go into the whole cross-sell effect. You need to have various different categories with completely different cash flow and margin profiles. If you can compound on that because you are damn equipment share, you have a fantastic brand, you have amazing founders, great capitalization, access to capital, great finance organization, and the customer access. So if you can actually deliver on that one-stop shop, I think you can be a $60 billion business. And if you can't diversify away from equipment, I think this is it.
I couldn't say it better myself.
So I think for us, super, super exciting. It will be, if they are successful, the second largest construction tech IPO to date.
To date, being the operative word. Yes.
Yeah. So who'll see? Who knows? Maybe I'm right about my prediction on Bricks, Bucks, and Bytes the other day.
Well done, sir.
Yeah.
I'm rooting for your prediction.
Thank you very much. Yes. So good discussion. Thanks, Shub.
Thank you.
And I wish you a happy weekend.
Good to be back on Practical Nerds after a while.
Indeed.
Yeah.
Thank you, sir.
Thank you.